Hey, hope you are well. In this video, I'm looking forward to sharing an option strategy that allowed me to make a decent profit with only a small amount of risk. We're talking 8 to 9x on this trade. It's a variation of an option strategy that I talked about in an earlier video. I spoke of the goals of this channel in my first video. It'll be different from the other channels you see out there in that I will show you the initial trade and the resolution. And this is regardless of whether the trade is profitable or not. This will allow us to learn and understand how option prices react to different events and circumstances. I also am a big proponent of not losing sleep over your trades, so I won't be highlighting any trade ideas where the reward does not justify the risk. So what did I do? Well, it's not the simple I buy a call and hope for the best. There are actually only a few times when such asymmetric risk reward is possible and where the probability of success is also reasonable. I'll go over that in a second. What I did is identify high price stocks with high volume that have just experienced or will experience a significant event, such as an announcement of new business or a pending earnings report release. The few times I've seen such an opportunity is with Amazon and Tesla. Once the stock is identified, make a guess as to where you think the price will be at expiration, and review the option prices and the cost to enter into a condor type trade. I won't get into the proper option lingo here, as understanding what you are doing is infinitely more important than using the proper name for it. I'm going to assume you have a basic understanding of options. As you know, when trading options, the risk and or reward is usually defined, but you also need to think about the probability, so keep that in mind for this. I'm going to call this a condor type trade, and it was basically two separate vertical option spreads. If you don't know what a vertical option spread is, it is the purchase of a call option at one strike price and the sale of a call option at another strike price. The expiration dates are the same, and they can both be calls or both be puts. In my prior video, I go over a basic vertical option spread, so please review that if you want additional information. So why was I comfortable in taking the trade on Amazon? I had a stance that Amazon's share price would react favorably to the earnings report. All public information supported that its business was doing well. However, the share price had already appreciated substantially in the days, weeks, and months leading up to the earnings date, which was on Thursday, July 30th. Therefore, my guess, and it's only an educated guess at best, was that the price would appreciate modestly from its current price that day of approximately $3,050. The reason I took the trade was that when I looked at the prices of the options, it allowed me to risk what ended up being less than $200 to achieve a potential max profit of $1,800. Therefore, for the potential 9x return, the trade was justified given the probability of it happening, of course, in my opinion. We'll go over the details of the strategy, but first let me show you the mechanics of how to make the trade in case you don't know. I don't have a screen capture from before, but this video will show you how to set it up. So for the first part of the trade, it was a buy of a 3130 call and a sell of a 3150 call. So go to your option order screen, select the 3130 call, and make sure it's a sell to open, or buy to open. Once you have that set up, go to the 3150 call and make sure it's a sell to open. Since the call that you're buying is more expensive than the call that you're selling, it will be a net debit, and we selected a limit order of $6.50. The second part of the condor type trade will be somewhat different. In this part, we are selling the lower strike call and we are buying the higher strike call. So go into the option order form, select the 3200 call and select it as a sell to open. Then go to the 3220 call and select it as a buy to open. In this case, I had set a limit order of $4.50 for a net credit of $4.50. I actually got a better execution price at $4.64. In summary, you'll see that I paid or had a net debit of $6.50 for part 1 of the trade and received a net credit of $464 for part 2 of the trade. The two completed sets of opening trades were spaced about 15 to 20 minutes apart. It's not always possible to get the best bid and ask prices when you're relying on 4 separate trades to execute at the same time. And when doing spread trades, your net debit and your net credit on a trade is less sensitive to stock price movement. So you have time to complete this condor type trade. I would actually argue that by bargain hunting on your option spread limit orders, you will get slightly better prices by separating it into two parts like I did. Hopefully you were able to follow this quick rant, but let me know if you have any questions. In combination, I risked less than 200 to potentially make over 1800. Please note that these screenshots are for executed transactions and they somehow, for whatever reason, list current quotes for the options. So please ignore the figures highlighted by the red arrows. They make no sense. Focus on the executed prices, which is what the green arrows are pointing at. So in my opinion, this is a great trade, regardless of the outcome. It's relatively stress-free. Also, and this is extremely important, super important, others may say you can buy a call option and try to get lucky. This is not the same. You can see that a 3150 call would cost $53.42, meaning it's a gamble with a max loss of $5,342. And it would only be profitable if Amazon's share price increased by at least $75 to $100 from the 3050 price at the time the option was purchased. If it didn't go up by as much, or if it actually dropped, that option would have expired worthless. So this condor type trade is definitely a better option. As you can see, the price of the share could be between $31.37 and $32.05, and the trade would be profitable by $1 to a max of over $1,800. That's a pretty large range of almost $70, so the probability in my mind was about 25% or so. Also, I knew that if the trade went against me, there was still the possibility that I could close the trade before expiration, so that I would not need to take the full loss of almost $200. So this is a good transition into managing the trade after the earnings report, which in this case was also the day of expiration. First, remember your max loss is capped, and you have already performed all the math before getting into the trade. There's usually no benefit to reacting when the price is volatile. As you can see, on that day, the price was well above my zone of profitability as it opened above $32.30. During the day, the price slowly drifted lower. Even before it reached the zone between $31.50 and $32.00, the trade was already profitable if I had closed it at that point. However, I was both greedy and cautious, and set limit orders I would be happy with for both parts of the trade. I eventually got what I think was a lucky execution, and was able to close part 1 of the trade for $1,900. Keep in mind that the max I could have gotten for that part was $2,000, so I was happy with closing part 1 of the condor position. Amazon eventually closed that day at $31.65, so if I had held to expiration, I would have profited even more, $100 more than my $1,700 profit. But of course, I'm not complaining, and I believe it was the right call at that time. A general tip for spread orders: definitely bargain shop on the limit price and take your time when trying to enter or exit a spread trade. You have time. I've used E-Trade, TD Ameritrade, and Interactive Brokers, and they all work great for these types of spread orders. The following are some ideas for my next video. I think the more relevant and pressing topics may be the last 2 bullets, and that is, how do you profit from selling puts on stocks, and how do you use leaps and diagonals to trade relatively stress-free. I'll go over some real trades and show you how the option positions reacted after the share price moved favorably for me and when it moved against me. This is valuable information, and you will be surprised on what I have to share. I'm doing the voiceover for this video as of Monday morning, and there are a few interesting things that came up that I may discuss further in another video. JMIA, which some are calling the Amazon of Africa, has recently seen its share price double. They are reporting earnings on Tuesday, and the premiums on the puts are extremely high. I was able to sell the $12 puts at 60 cents, but have now since bought them back for 40 cents. I closed the trade because it was a decent percentage profit, but I would have been comfortable holding them through earnings if I couldn't realize a decent profit today. That is because the chart showed strength, and the $12 strike is significantly far away from its current share price of $20. That is like a $200 stock dropping $80 to $120, which doesn't happen usually even after a bad earnings report. Another trade to highlight is a bullish vertical spread that I took on DraftKings. It's trading at about $31 and reports earnings Friday morning. There is already a lot of negativity on the business due to the current climate for the NFL and Major League Baseball. I'm confident that when the short interest report comes out Tuesday evening, you'll see that the number of shorted shares has increased significantly. Basically, most are already preparing for the worst. Therefore, I went long, as there is a potential for this trade to be profitable, even prior to earnings and after. And as you can see, the risk reward is $160 to make $440. I believe the same price is available right now, as spreads don't fluctuate significantly. I just dipped my toes into this for now, but may add more once I've had a chance to look into it. Before concluding this video, as noted on the second slide, this video and channel is for information and entertainment purposes only and should not be construed as investment advice or as a recommendation. Please do your own research before making any trades. With that, I'd like to conclude this video. Thanks for watching and listening. I hope you were able to learn from this and found it useful. Perhaps you will come up with your own ideas using this strategy and let me know. If you liked the video, please hit the like button and subscribe. Thank you.